Welcome back. In this final portion of our bond coverage, we're going to talk about bond valuation. So what are we going to do? Well, first I'll actually walk you through a number of examples using really techniques that we covered using the time value of money buttons on the BA2 calculator. And then I'll talk about some of the factors that affect bond prices, namely time to maturity and then also interest rates. And then finally, we'll wrap up by calculating the yield to maturity, the yield to call, and the current yield for a much more in-depth example. So let's go ahead and get started. All right, to start things off, I'm just going to jump right into an example, and you can kind of see how we actually price bonds. As you'll notice, pricing bonds is very similar to what we did in the chapter 4 in the time value of money material. So we actually use the same buttons on the BA2 calculator, and we also use, if we want to, the cash flow stream that we introduced all the way back a couple of weeks ago. So I'm going to start off working this example. And so in this example, Apple is issuing junk bonds with a coupon rate of 8% and a YTM, or yield to maturity, of 12%. The bond pays coupons annually and matures in 5 years with annual coupons. What price will investors pay for these bonds? All right, so to start this one off, what I'm going to do is I'm actually going to draw out the stream of cash flows, and then I'm going to talk about how we actually price this bond. It's actually very similar to what we did in the time value of money section. So to start off, I'm going to put year and cash flow, and because this is a bond where we have 5 years worth of coupons and each of these are annual coupons, I'm going to put out here 5 years, 0, 1, 2, 3, 4, 5. Now, what we're going to do to price this bond is we're going to calculate the cash flow that you as an investor receive at each point in time, and then we're going to discount that cash flow back to the present. And we're going to do that for each of these coupons and the face value of the bond. All right, so let's start off by calculating the coupon that you receive as associated with this bond. Now, our coupons are calculated by multiplying our coupon rate by the face value of the bond and then dividing by the number of payments or number of compounding periods we have each year. Now, because we're receiving coupons annually, that means that the number of compounding periods that we have is equal to 1. That's something that you'll see exactly why that's such a big issue in a few seconds. So our coupon in years 1, 2, 3, 4, and 5 is going to be just 8%, or 0.08, times our face value divided by 1 payment per year. So this is going to be equal to 80. Year 2, year 3, year 4, and year 5, we're all going to have cash flows equal to 80. Now, in year 5, we also receive the face value of the bond, or as it's sometimes referred to, the par value of the bond, or the future value of the bond. So that's it. Those are the cash flows we receive by holding this bond. And we're discounting them all at a rate of 12%, or 0.12. So we're going to use the time value of money to discount each of these cash flows. So $80 in years 1 through 4, and then $1,080 in year 5, back to the present, and we're going to sum them up, and that total will give us our present value of this bond. Now, because this is our first example, I've already put the answer and the inputs to your BA2 calculator up on our screen. So, like I said, since our coupon rate is 8%, that means that our payment is going to be 80 every single year. And I realized a couple of weeks ago when I introduced the BA2 calculator, I just automatically said our payment for a lot of the assets that we were talking about was equal to 0. Now when we talk about bond valuation, this is the part of the course where I actually get to add in coupon payments. So our coupon is actually our PMT, our payment. So to start us off, I'm going to put in 80 PMT. Tell the calculator that our payment is equal to 80. But actually, before I go any further, I'm going to change the format of this calculator so that it has a floating decimal. All right, now I'm going to just type in 80 and let's get going. Now, our par value or face value of this bond is, like for every corporate bond, or most corporate bonds I should say, equal to 1,000. Now, one thing I should note, I'm putting 1,000 in here, and that 1,000 tells the calculator that at the end of year 5, we're receiving $1,000 as an investor. The payment tells the calculator that we're receiving $80 at the end of every period. And our N here, because we have 5 years until maturity, is going to be equal to 5. And our yield to maturity, which was just given, is 12%. So we enter that in as 12 under the I divided by Y, or yield. Finally, we can compute the present value by hitting CPT and PV, and that gives us a present value of negative $855.81-ish cents. Now, notice here that we have a negative, and I've mentioned this a couple of times so far, but the reason we have a negative is because from our perspective as a bond investor, that $855 is a cash outflow. We're making that cash outflow in order to receive those $80 coupon payments and the $1,000 face value. So that's that. Now there is one other thing I should note here. Notice that the absolute value of our bond, or rather the absolute value of our present value, is about $855.81. This is less than our par value of $1,000. Now, whenever our present value is less than our future value or par value, we have what's called a discount bond, meaning that this bond is selling at a discount to face value. Now, let's take a look at another example. So let's say that we want to know, well, let's say, what if Ford Motor Company decided to offer bonds with a coupon rate of 11%, a yield to maturity of 6%, and a time to maturity of 10 years and annual coupon payments? What we're going to do is we're again going to calculate the present value of this bond. Now, I'm going to, for the last time here, draw it out on the timeline of cash flows. So here we have year and cash flow, and we have a lot of cash flows. 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. Now, our coupon rate here is 11%. And because we have annual coupons, this means that the amount we receive in the form of a coupon payment is going to be 11% times our face value, which is just assumed to be $1,000 because this is a corporate bond, divided by the number of payments or number of payment periods per year, which is just 1 because we have annual bonds or a bond that pays annual payments. So in this case, our annual coupon is 110. It's 110 for every single payment. And then in the final period, we have a $1,000 face value plus that final 110 coupon payment. And the present value is just going to be the discounted value of all of these cash flows discounted to the present. All right, so let's go ahead and see what we would input here with the calculator. And like the previous example, I've gone ahead and already done it. In future examples, I won't always do this. But in this case, our coupon rate was 11%. And because we have annual coupons and our par or face value is $1,000, this means that our payment is going to be 11% times the $1,000 divided by 1 because we have annual coupons. So here, we're going to put into our calculator, once we clear out the time value of money inputs that we had in the previous example, we're going to put in 110 as our payment. Next, our face value, or FV, is $1,000. Our I divided by Y is given as 6% in this case. And our N here is 10. So in this case, we can compute our present value, and that's going to be about $1,368 even. So remember, this is a negative, so it tells us that if we want to buy this stream of cash flows that we have, $110 coupon payments and then a final face value of $1,000, we're going to have to pay $1,368 today. Now, notice here that the absolute value of this present, the absolute value of this present value is greater than our face value. So 1,368 is obviously greater than 1,000. This means that definitionally this Ford bond is what we call a premium bond. It's selling to a premium on the face value. All right, let's go ahead and work one more example, this time without the example worked on the next slide. So in this example, you're considering buying a bond with a 10% annual coupon rate, 12 years to maturity, and a par value of $1,000. The current price is $855.44. What is the yield to maturity on this bond? All right. Let's go ahead and just work this directly. I'm going to clear out our time value of money buttons. And here, our coupon rate is 10%, and we have annual coupons. And our face value is definitionally $1,000. Even if it didn't say that, that's what we would assume. So our payment is going to be 10% times $1,000 divided by 1 because we have annual coupon payments. So in this case, our payment is 100. Our face value is again 1,000. Our current price is $855.44, but because we are purchasing this bond, this $855.44 is a cash outflow from our perspective. So when we put it in the calculator in the time value of money buttons, we need to reflect that cash outflow. So I'm going to make this $855.44 a negative number. So 855.44, and I'll hit this plus minus sign. And then I'll set it to equal our present value. Next, we know that we have 12 years to maturity, so N is 12. Finally, we can compute the yield to maturity on this bond. All we're going to do is just hit our compute and then I divided by Y, and that gives us a yield to maturity of 12.37%. Easy enough. Okay, now we're going to switch it up a bit, and we're going to add semi-annual coupon payments rather than annual payments to our analysis. So to walk us through this, I'm going to use an example. And in this example, you are the CEO of Amazon, and you decide that you need to build a new warehouse in Southern California. To fund this project, you will need to issue new bonds. You decide to offer bonds with a 5% semi-annual coupon and a yield to maturity of 8% compounded semi-annually. The bonds mature in 5 years. What price will investors pay for these bonds? All right, so the way we work an example where we have bonds that pay out coupons semi-annually is that we change the number of payments, the interest rate, and the payment so that we indicate that there is a semi-annual payment. So we're going to do three things. First, we're going to double the number of periods because our number of periods until maturity is doubling when we have semi-annual coupon payments as opposed to annual payments. Next, we're going to cut our I divided by Y in half because our I divided by Y, which is our interest rate, has to have the same periodicity as our coupon payment, which is going to occur semi-annually. So if we have a semi-annual coupon payment, we need a semi-annual interest rate. And finally, our coupon payment is going to be calculated not with a 1 in the denominator this time, but rather a 2 in the denominator. So let's go ahead and plot this on our timeline of cash flows. So we have our year, our CF, and in this case, although we have 5 years to maturity, because we have semi-annual coupon payments, we're actually going to have 10 periods. So it runs from 0 to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And our coupon payments in each period are going to be calculated using the formula I gave you a few seconds ago. It's just our coupon rate, in this case it's 5%, times our face value, in this case it's 1,000, divided by the number of coupon payments we have per year, in this case 2. So our semi-annual coupon is actually going to be 25. And from our perspective as the CEO of Amazon, this coupon is actually going to be a cash outflow. Remember, we're receiving this cash up front in year 0 or time period 0, and we're paying this cash out in time period 1, time period 2, all the way up to time period 10. So from our perspective as the CEO of Amazon, Jeff Bezos, this is a negative number. So I'm going to put a negative here to reflect that it is a negative number. So for each period, at the end of every 6 months, we're making a $25 cash outflow, and at the very end, we're going to also make the face value payment, and that's going to be a cash outflow from our perspective. So we're going to put a negative 1,000 and a negative 25. Now, all of these other lines on this timeline of cash flow are going to be negative 25 as well. All right, now let's actually go through and see how we input this example into our BA2 calculator. All right, so when we put this example into our BA2 calculator, because we are the bond issuer, the borrower of this capital, our face value is going to be negative 1,000. We're paying out that $1,000 from our bond from our perspective at the end of year 5 or time period or N of 10. Next, our payment is just going to be, as I have up on the screen, our coupon rate times our face value divided by number of periods per year. And we've already worked that. And we've already indicated that's a negative number. Next, our I divided by Y is going to be our yield to maturity divided by the number of periods per year. Remember, our I divided by Y has to have the same periodicity as our payment. If we have a semi-annual payment, we need a semi-annual interest rate. So in this case, our semi-annual interest rate is going to be our annual interest rate of 8% divided by 2, or 4. We're going to input this as 4 in our BA2 calculator. Next, our N is going to be our number of years times our payments per year. So we're maturing this bond, or this bond matures in 5 years, and we have 2 payments per year, so N is equal to 10. And now let's just go ahead and enter this into our BA2 calculator. I'm going to put 10 equal to N, I divided by Y is equal to 4, 25 negative, so negative 25 is our payment every 6 months, and lastly our face value is a negative $1,000. And let's compute our present value. So our present value is $878.34, I should round. What that means is that if we wanted to issue this bond today, we could receive $878.34 for every one of these bonds we issue. And we're going to have to pay back that $25 coupon payment every 6 months plus the face value at the end of that 5 years. All right, let's do another example. All right, a corporate bond issued by Apple has a face value of $1,000. The bond has a coupon rate of 5% and semi-annual payments. Apple is selling this bond for $750. The bond matures in 10 years. What is our yield to maturity on this bond? All right, well, since I've already gone through one example similar to this, I'm just going to go ahead and enter this in our BA2 calculator. So I'm going to clear out the BA2 calculator by hitting second and FV, and we know that our face value, because it's a corporate bond, is $1,000, so I'm going to put in $1,000. Next, we know that this bond is being sold for $750. That's just given right here. Apple is selling this bond for $750. And because our face value is positive, we're going to have to put our present value in as a negative because it's a cash outflow from our perspective as the bond investor, the lender of this capital. So that's our PV. Next, because this bond matures in 10 years and it has semi-annual payments, our N is going to be the number of years times the number of payments per year, or 10 times 2, so 20. Next, we need to calculate the payment for every 6 months. So our coupon rate here is 5%, and our face value is 1,000, and we know we have semi-annual payments. So what we're going to do is we're going to take that 5% times 1,000 and divide that by 2, and that will give us, again, a $25 payment. So that's what I'm going to enter here. So from our perspective as the bond investor, the lender of this capital, this is something that we receive in the future after we lend this money today. So that's why it's a positive as opposed to the previous example where it was a negative. So now all we have to do is compute I divided by y. And in this example, our I divided by y is 4.4%, or 4.4. Now, remember, our I divided by y has the same periodicity as the payment. We have a semi-annual payment, and this means that our I divided by y is actually a semi-annual yield. The last step in this problem is to multiply the semi-annual yield by 2 to get this equal to an annual yield. So that's what I'm going to do. Multiply by 2, and what this tells us is that our yield to maturity is 8.81%. This is in percentage terms, just because it came out of the I divided by y button. So our yield to maturity, or our compensation for investing in this bond, is about 8.81%. All right, let's try one more example, and I realize I'm beating this to death, but I think repetition is probably something that's called for in this case. So another example with semi-annual coupons. So suppose a bond with a 10% coupon rate and semi-annual coupons has face value of $1,000, matures in 20 years, and is selling for $1,197.93. What is the yield to maturity? All right, fairly basic. Let's just go ahead and enter this in one last time. First, I'm going to clear out the time value of money buttons. And there we go. All right, let's start off with the easy stuff. Our face value, because this is a corporate bond, is $1,000. We know that we're paying $1,197.93. This is a premium bond. Because it's a cash outflow from our perspective, we're going to enter it in as a negative number. So 1197.93, and let's make that a negative and hit PV. Next, let's get the number of periods. Now, because this matures in 20 years and we have semi-annual coupon payments, this means that our number of payments we're going to have to receive for holding this bond is going to be number of years times number of payments per year, so 20 times 2. So in this case, our N is equal to 40. Now, let's get our payment. And so in this case, our coupon rate is 10%. Our face value is 1,000. So the numerator for the coupon is going to be 0.1 times 1,000, so 100. And because we have semi-annual coupons, we're going to divide that by 2. So in this case, our coupon payment every 6 months is going to be 50. Lastly, let's calculate the I divided by y, and in this case, it's very close to 4. I'm just going to round up to 4. And remember, this is our semi-annual interest rate. The last step is to multiply this by 2, and that gives us a yield to maturity of 7.999%. And because I wrote this problem myself, obviously I know that I was going for a coupon or a yield to maturity of 8%. There's a slight rounding error. It's all right. Essentially, our yield to maturity in this example would be 8%. All right. Let's try one more example where we get the price of a bond. And in this example, Tesla has issued a bond with a face value of $1,000, and the bond has a coupon rate of 6% with semi-annual coupons. The yield to maturity is 8%, and it matures in 5 years. Apparently, I stink at grammar today. All right. What should the price of this bond be? All right. So because I've already done another example similar to this, this is really just repetition for us, so I'm just going to go ahead and enter in the components in the BA2 calculator. So I'm going to clear out the BA2 calculator, and I'm going to start off with the face value because that's easy. $1,000. Next, we have a time to maturity of 5 years, and we have semi-annual coupon payments. So that means that we have 10 payments. Next, let's get our coupon rate, or our coupon payment. So our coupon rate is 6%, face value is $1,000, so we're totally paying out $60 in coupon payments every year, but because we have semi-annual coupons, we divide this by 2, and that gives us our PMT equal to 30. Lastly, let's get our I divided by Y. So our yield to maturity here is 8%. And to get our I divided by Y, we need to convert this 8% to a semi-annual figure. So what I'm going to do is I'm going to divide this 8% by 2, and that gives us an I divided by Y of 4%. So I'm going to put in 4. Lastly, let's compute the price. So the price of this bond, the fair value of this bond, should be right around $918.89. And remember, because this is a cash outflow, it's a negative number from our perspective as bond investor. So if you wanted to buy this bond with these coupon payments and this face value and this interest rate, you're going to have to pay $918.89. Fair enough. All right, now let's talk about the biggest relationships you should know about the price and some of the other factors that go into a bond. Now, when our coupon rate is equal to our yield to maturity, what that means is that our price is going to be equal to our face value. This is something that's universally true. If you're receiving a 5% coupon payment per year and your yield to maturity is 5%, then the price that you would pay for this bond would just be $1,000 because your interest rate would just be equal to the coupons that you're receiving. Now, if our coupon rate is less than our yield to maturity or our interest rate, then we have a case like the very first example I gave you, where we have a discount bond, meaning that the price is less than the face value. Finally, if the coupon rate is greater than the yield to maturity, that would be a case where the price is going to be greater than the face value. In other words, we have what's called a premium bond. Now, to illustrate this a little more graphically, I've put up a very quick example. So in this example, we have the price of a bond listed on the y-axis and the time to maturity listed on the x-axis. And as you can see, the red line indicates a premium bond, and as we get closer to maturity, the value of that premium bond is going to track closer and closer and closer to the face value. It essentially depreciates to the face value. With a discount bond, the value is going to, or the price is going to appreciate up to that $1,000 face or par value. So this is really how prices of bonds move, depending on whether they are a premium or a discount bond. All right. Now, one other relationship I need to mention is the relationship between the yield and the price of a bond. And if you are in my class, I have put up the Excel document where I actually calculate what you're seeing right now. Feel free to go through it. Feel free to mess around with it. But if you're just watching this video, I've just gone ahead and put up our slide with that same graphic that you'll see in the Excel document. All right, so what am I trying to show here? Well, what I'm trying to show here is that there is a very definite negative relationship between the yield or interest rate on a bond and its price. The higher the interest rate, the lower the price. So as interest rates rise, typically bond prices fall. So to illustrate that, what I've gone ahead and done is I've calculated the prices for 3 bonds. One with a coupon rate of 2%, that's the yellow one with a coupon rate of 4%, and one with a coupon rate of 6%. And I've plotted their prices or their present values with various yields to maturity. So this one over here, the yellow bond, has a coupon rate of 2% and a yield to maturity right here of 10%. So as you can see, because our yield to maturity is greater than our coupon rate, the price of this bond is a little less than 600, maybe 500 something. That's less than our par value, which tells us this is a discount bond. Notice that as our yield to maturity or interest rate decreases, the price of the bond increases. So this is just one of the most well-known universal truths about bond pricing. As the yield to maturity falls, the price of the bond increases. And the one final point I want you to note is that as our coupon rate increases, the price of the bond is going to increase as well. So as our coupon rate goes from 2% to 4% to 6%, the price of the bond is going to jump up correspondingly. The reason for this is because you're receiving coupon payments that are larger and larger every time you increase the coupon rate. All right, now let's talk about 2 risks that bondholders do have to worry about, reinvestment risk and price risk. Start with reinvestment risk. So reinvestment risk is a risk that's associated with investors who eventually receive the face value of their bond and then need to find some other place to park that cash. The reason reinvestment risk is such a big concern to bond investors is because if those investors have their bonds mature during a recessionary period or during a period where there's no good investment opportunities, now they're kind of stuck. There's no other place to reinvest that cash. So this is something that's prevalent and a very big concern for bond investors because, we have a fixed time to maturity. Assuming there's no call provision, put provision, or any other provision. Let's say this is just a vanilla bond. Reinvestment risk is a very real concern. So it might be better for bond investors to have a longer time to maturity to avoid reinvestment risk. The next risk that we have is something called price risk. And price risk is the risk that if the bondholder decides to sell the bond, the current interest rate will be higher and therefore the price of the bond will be lower. Now, remember that very universal truth I mentioned a few seconds ago about bond prices and interest rates. When interest rates rise, bond prices fall. Now, the reason price risk is such a big concern to investors or bond investors is because if a bond investor buys a bond, and let's say that bond has a time to maturity of 10 years, and that bond investor wants to sell that bond before that 10 years is up, they can do it on the open market if they can find another buyer for that bond. Well, if interest rates rise during that period, the price that they could sell that bond for is going to fall. So if you're a bond investor, interest rates rising is a very serious concern because it means that you might not be able to sell your bonds for the price that you would want to sell your bonds for. All right, let's wrap up by talking about three of the remaining definitions that you'll see in our material, in our text, in our textbook. All right, the first definition that we have is the yield to call. And the yield to call is associated with a call provision on a bond or a call option on a bond. What is a call provision? Well, a call provision is a provision in the bond indenture agreement that tells investors who buy these bonds that the bond issuer, the company, has the right to call this bond and pay it off early for a set price called a call price. It's essentially retiring this bond, usually by issuing a new bond or using cash that it has on hand. So you might ask, why would a bond issuer do this? Why would a company do this? Well, it's very simple. If interest rates fall during the time period between when the bond issuer issued this bond and now when it's deciding to exercise this call provision, this bond issuer would be able to issue a new bond with a lower interest rate. In other words, its cost of debt would decrease if it were to issue a new bond with a lower interest rate. This is something that is, it's very beneficial to companies that issue these bonds with call provisions. In fact, most bonds in the United States, most corporate bonds, come with a call provision because the benefit of declining interest rates is very good for companies that have the ability to issue new bonds. It's a way to reduce the cost of debt of the company and the interest expense of the company. So our yield to call is calculated very similarly to our yield to maturity. The only differences we make, and there's only two differences we have between the yield to call and the yield to maturity. First, our call price becomes our face value becomes the call price if we're using the time value of money buttons on the BA2 calculator. And second, the time to maturity is replaced by the time to call. That's it. We're only changing the FV and the N in the time value of money buttons. We'll do an example here in a few seconds. Now, the last two definitions I want to throw at you are the current yield and the capital gains yield. Let's talk about the current yield first. Now, the current yield is something that's very frequently reported in the Wall Street Journal or other financial publications to report the actual income that you as a bond investor will receive if you invest in a particular bond. It essentially represents the total coupon payments that this bond will pay every investor, and it scales those coupon payments by the present value of the bond, the price of the bond. So if let's say our current yield is 8%, that tells us that that bond is paying out coupon payments over the course of the year that are equal to 8% of the present value. Now, the other definition that we have here is the capital gains yield, and it's used a little less frequently. Suffice it to say, the capital gains yield for a bond is really just the return on the price of the bond over a period of time. All we do is take the price of a bond at the end of a period minus the price of the bond at the beginning of the period and divide that by the price of the bond at the beginning of the period. It's just our basic return formula. All right, now let's go ahead and use one final example where we calculate the yield to maturity, the yield to call, and the current yield, all in the same example, and we can see the differences between all three of these. So to do this, I'm going to get another scratch piece of paper, and I'm going to go ahead and draw out our timeline of cash flows just one last time. I think in some of the previous examples I was using year. I should have been using period, just to indicate that we have semi-annual periods. All right, so we have 5 years to maturity, which means that we have, since we have semi-annual payments, that means we have 10 periods to maturity, 10 semi-annual payments that we're going to be receiving as the investor in this bond. So I'll just write these out. 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. All right. Now, if we allow, or if the firm that issues this bond allows it to mature, then from our perspective, that's a pretty good thing. That means that we, as the bond investor, receive $1,000 in terms of the face value, plus whatever the coupon payment is. So in this case, our coupon payment is going to be our coupon rate of 4% times $1,000 divided by 2. And that's just going to be 40 on top divided by 2, so 20. So that $20 is what we receive every single period. And we're going to discount that at a yield to maturity, well, at some rate, and we know that that bond is priced at $892.18. All right, so what do we know? Well, our face value, if we're calculating the yield to maturity, is going to be equal to $1,000. Our payment is just what we have up here, 0.4 or 0.04 times $1,000 divided by 2, so $20. Our PV, which is a cash outflow from our perspective as the bond investor, is negative 892.18. Our N is 10, and we can compute our I divided by Y, and that's exactly what I'm going to do on our BA2 calculator. I'm going to bring it over here. So I'll clear out our BA2 and enter our information. Our FV is 1,000, our PMT is 20, our PV is 892.18 negative, and our N is 10. And let's compute our I divided by Y. That is, we'll just say 0.0328. Remember that I divided by Y is in percentage terms. That means our yield to maturity is that semi-annual I divided by Y times 2. So 0.0656. So 6.56%. So that's that. All right. Now let's calculate the yield to call next. Remember, with our yield to call, the only two things we're changing are our FV and our N. We're going to replace our FV with the call price. That's the price that the company or the firm that issued this bond is going to pay us as the bond investor if it calls this bond early. And the N is going to be the time until the bond is called. So in this case, in this example, this bond can be called in 2 years. And that means that our N here is not going to be 10, it's going to be 4. So 2 years times semi-annual payments. So let's just write out everything that we're going to enter. So in this case, our FV is going to be 948.22, just our call price. Our PV is again going to be, well, we'll do these in order. So our PMT is going to be 20 again. Our PV is going to be negative 892.18. Our N is going to be equal to 4, and we'll compute our I divided by Y. And I'm going to use the BA2 calculator to do that. So clear everything out. I guess I didn't have to, but what the heck. 948.22 is our face value. 20 is our payment. Negative 892.18 is our PV. 4 is our N. And I'm going to compute our I divided by Y. And that's 3.723. We'll round up. So I'm going to put that in decimal terms. So 0.0373. So our yield to call is just 0.0373 times 2. And what the heck, I'll use the calculator. .0746 or 7.46%. Just move that over so you can see it. Okay, so that's that. So notice here that our yield to call is higher than our yield to maturity. Sometimes that happens. All right, let's calculate the current yield, the last thing that we have. So I'm going to get rid of this stuff, and I'm just going to write our current yield formula. Our formula here is just our total annual coupon payments. That's the sum of all the coupon payments we receive as a bond investor during the year. and we're going to divide that by the PV, the present value. All right, so in this case, all we have to do to calculate our annual coupon payments is just take our coupon rate of 4%, 0.04, times our face value. So that's 40 on top, and our present value is just going to be 892.18. Or I should say, let's just call this the price of the bond. So that way we don't have to worry about this being a negative or a positive. So if we wanted to buy this bond today, it'd be $892.18. So we'll just solve for our current yield. So 40 divided by 892.18 gives us a current yield of 4.48%. So if we purchased this bond, we would receive 4.48% of our present value every year as coupon payment. Or I guess I should say total from our 2 coupon payments. So that's that. We've calculated the 3 most basic yields that are used in bond investing, and we've also priced a number of different bonds with annual coupon payments and semi-annual coupon payments. So let's wrap up. All right, what do we do? Well, we talked about the fact that bonds are priced using the techniques we covered in the time value of money section that you probably noticed 1,000 times in the last few minutes. We just use the time value of money buttons to calculate the price of bonds. Next, most bonds with coupons will make semi-annual payments. So what we did in those last 5 or 6 examples, that's fairly common. I mean, if we're valuing corporate bonds that make payments, chances are they're going to have semi-annual coupon payments. Next, we noted one of the most important relationships between bond prices and other factors, and that is that bond prices are negatively correlated with interest rates. When interest rates rise, bond prices fall. And lastly, we talked about the fact that corporate bonds are callable. So if you are a bond investor or considering becoming a bond investor, not only should you be calculating the yield to maturity, you should also be calculating the yield to call and ideally the current yield. So that's that. Now, if you do have any questions about bond pricing or anything else, please email me, please call me, please stop by my office hours. I would love to hear from you. But we're going to wrap up, so thank you very much.